We have plenty of time for questions and discussion. I am going to hand over now to Vasilis Kostoulas, who is the digital media and managing editor of Katamarini newspaper, who is joining us to ask a question of each of our panelists this morning. So Vasilis, over to you.
Good morning, Joan. Good morning, distinguished speakers. It's a pleasure to be with you today. I would like to ask Mr. Centeno and Mr. Dombrovskis. Firstly, will you request that Greece, a country which remains in a state of enhanced surveillance, implements obligatory reforms before allocating money from the Recovery and Resilience Facility? And secondly, will it be possible for Greece to use this money for tax reduction? Mr. Centeno.
Good morning again. Well, and thank you for your question. Indeed, your question is better placed to the European Commission, but let me just make what I think an important point. We need to understand that these funds will be temporary. There is a clear expiry date, and this is why we have to look at them even more as an opportunity. Indeed, a golden opportunity to kickstart our economies in these times of crisis and make them stronger and more future-proof. Reforms are part of that process. Make no mistake. So I cannot agree to make reforms a dirty word. But we are also in a moment in which European integration is taking quite important steps. And this is something that can only make our commitment with all countries even stronger, and receive from those countries also a strong commitment to Europe. And this is quite important. Thank you.
Thank you. Mr. Dombrovskis?
Thank you for this question. So first of all, as regards recovery and resilience facility, Greece will be treated the same way as every other member state. So basically, recovery resilience facility puts member states in a driving seat on this when they are designing their recovery and resilience plans. And we would then finance investments and reforms in line with recovery and resilience plans designed by member states. So in case of Greece, what it provides now additionally, in a sense that Greece will be able to finance some of the reforms which are a part of the enhanced surveillance process with the help of recovery and resilience facility. So in a sense, recovery and resilience facility may provide additional financing for these reforms. Then when we discuss specifically, you said tax reductions, I think we now shouldn't be jumping, so to say, ahead of the events. It's now for, well, once facility is agreed and adopted, of course, for member states to propose their recovery and resilience plans, which the Commission will assess as a whole plans based on the challenges identified in European semester, based on our goals and of green and digital transitions. So it's too early to start passing judgment of different elements which may or may not be part of those recovery and resilience plans. So the first steps will be now for member states to prepare and present those plans. And in order to ensure that this money can start flowing as fast as possible, we encourage member states to do it fast already in autumn.
Thank you. A question for Mr. Staikouras. Which scenario, Mr. Staikouras, would you be satisfied with for 2020, given the conditions in the Greek economy? Moreover, are you certain that Greece doesn't have to make use of the low-cost borrowing of ESM, even with a negative interest rate for its expenditures?
First of all, we would be satisfied with the basic scenario. We know very well that uncertainty is great and unprecedented. All European institutions revive often their estimations and provide a wide range of projections. We know, you know very well, that the Greek economy entered 2020 on a sound footing with promising perspectives as praised by the European Commission and its forecasts. Unfortunately, this course came to an abrupt halt due to the coronavirus crisis and the symmetric shock globally. Our estimate is for a deep recession in 2020, which, after the adoption of the expansionary policy fiscal measures, will be reduced significantly, addressing as much as possible the social and economic consequences of the crisis. Yesterday's preliminary figures for GDP for the first quarter of 2020 were relatively satisfactory. Indeed, the European Commission has recognized the rapid political reaction of the government in the economic field, noting that this lays the groundwork for a dynamic recovery in 2021. Regarding the second part of your question, the decision concerning the ESM pandemic crisis support was one of the important steps we took at the Eurogroup level. Based on the current data, Greece does not need to resort to the ESM's credit lines, since the government has made and continues to make a responsible and prudent use of the country's own resources. The cash resources of the general government and its entities are appropriately utilized, while resources are also successfully drawn from the financial markets despite the unfavorable international environment. Moreover, we are ready to use the new European financial instruments such as the SURE program and the EIB fund. In any case, the ESM weapon is available until the end of 2022. Thank you.
Thank you, Mr. Staikouras. And I would like to ask Mr. Megalou, where will the effort of the Greek banks to manage non-performing loans be based from now on, following the emergence of this new crisis? And what message would you send to the potential borrowers who will try to raise liquidity in the coming months?
We are determined to support viable customers to survive the economic impact of the current pandemic. We have the tools and the appetite to support them, and this way we will also make a great effort to minimize the formation of new non-performing loans. We will continue our effort to reduce our existing NPL load with the help of products like Hercules and the partnership with world-class servicers like Intrum. The Greek banks are in a position of strength into the crisis with capital and liquidity adequate to address the immediate aftermath of the crisis, and they will make every effort to finance the economy in a way that will assist the viable clients going through the crisis.
Thank you for taking my questions. Enjoy the rest of the event.
Thank you very much, Vasilis. So we have still 22 minutes for the discussion, including Mr. Centeno. So we will carry on and then we'll have a further 15 minutes. So we've got plenty of time now. So I've got some questions from the audience and I have questions of my own. So we'll try to work through some of those. So let's start maybe with a broad question, which any of you can answer. We've heard lots of allegations that EU solidarity has been sorely lacking. The bloc was too slow to support those in need, in particular Italy and Spain, which have been ravaged by this crisis, a crisis not of their making. So why has it taken the EU so long to get to the stage of a proposal for a recovery fund, Next Generation EU? And just if you can comment also about the timeline, because the timeline for the approval of the plan in the first place is quite long, as I understand. Once it's approved by the Eurogroup, the European Council, the European Parliament, all 27 member states need to approve it. So that makes debt issuance before 2021 quite unlikely. But do Spain and Italy and Greece not need this funding now? Is this not a case of too little, too late? So perhaps start with Mario.
Okay, thank you, Johan, and thank you for your question. Very interesting and also very well placed. Let me tell you that I don't agree with the view that Europe was slow to respond. We actually, as I mentioned in my introduction, took 10 days to approve in the Eurogroup a very broad package of support for workers, businesses, and sovereigns. This is what brings confidence to all market citizens, politicians in national countries, in each of our countries to take decisions with the comfort of these backstops. Right now, we are all focused on getting this package approved ahead of the summer break, which it's much deserved this time. A swift approval will provide, again, confidence to member states to develop their national recovery plans. It is important that we are prepared to hit the ground running in January, perhaps even before for some of the measures of the package. I must recall that markets are open and will remain open. Spreads are falling and all countries have access to funding. So the Resilience and Recovery Fund will strengthen all of these. Two more points. First, the Commission is proposing an increase in the budget for 2020 already, which will help to make a bridge toward the next MFF and the recovery plan. Second, let us not forget that we have agreed and made ready 3 safety nets of a total of 540 billion. These are at the country's disposal to finance job retention schemes, provide guarantees to businesses, and train and assist sovereigns with credit lines to finance health-related costs already this year. There is plenty of funding here for all countries. Making this long story short, there are several envelopes for countries to draw from ahead of the recovery funds. We can also evaluate that 750 billion is not too little by any relevant standard. To understand the magnitude, it's 5 times the EU 2019 budget. And while it will be spent in several years, it will focus on the countries most affected by this crisis. I think, very honestly, that there is a true macroeconomic relevance here. And this time around, Europe is not to be blamed for being slow to respond, to be uncoordinated, or to leave parts of it behind. I think this is probably one of the greatest examples in the last decade of how Europe can move and is moving together. Thank you.
Thank you very much. Thank you very much for your direct reply. Vice President Dombrovskis, did you want to add anything to that?
Yes, indeed. I can agree very much with what Mário Centeno already said. And indeed, EU has reacted fastly and boldly to this crisis. I already mentioned the figures, 3.4 trillion euros, which had been mobilized collectively by EU and its member states as a response of the crisis. Mário Centeno already mentioned the three safety nets which are agreed, sure to protect jobs, Pan-European Guarantee Fund to provide loans to European companies, especially SMEs, and the ESM support instrument to provide financing for member states. So 540 billion euros, which are agreed, but which are not yet flowing to member states, but this money will be available and member states will be able to use. And this also doesn't comes, so to say, in empty place. Already now we had been implementing, for example, Corona Response Investment Initiative, providing maximum flexibility and 100% European financing to the EU funds, which are still available under this multi-annual financial framework. We created a new emergency support instrument to support healthcare response in the most affected countries. We activated RescEU, other EU budget programs. So we have used everything which we have in EU budget now. We have provided necessary regulatory flexibility in our fiscal rules, state aid rules, prudential rules as regards financial sector. So all this is already in place. Part of this money is already flowing to the economy. Some of this money will start be flowing soon. So when we are now coming with a recovery instrument, next generation of EU of 750 billion euros, it comes on top of what already is in place, and as the name suggested, concentrates already on the recovery stage of our economy. Even though also within that package there are also some more like immediate crisis instruments. I already mentioned React EU, which is basically a top-up of the cohesion policy, which should be going to member states already this year and provide more like still emergency support and funding. So what we have designed and implemented in those last couple of months is a whole variety of different instruments. So our 750 billion euro package now comes off top of many things which had been decided and implemented already.
Thank you very much. Mr. Staikouras, did you want to make any comment on that from the perspective of a member state? You've already emphasized that Greece has been coping quite well already in terms of its own resources without resort to ESM funding. So are you happy with the degree of support and indeed the speed of disbursement of funding?
Let's leave aside the disbursement of funding. Let's stay for a while on the decisions. More or less, I will agree with Mario and Valdis. Experience shows that Europe and the euro area often need time to respond to the challenges they face. Thankfully, in the case of the COVID-19 crisis, the response was immediate and drastic decisions were taken to tackle the crisis. Compared, as I mentioned before, with a decade ago, Europe has reacted collectively, taking important decisions and activated both fiscally and on the liquidity side on a proper way. As I mentioned before, and I would like to concentrate on that as an example, fiscal targets and restrictions were lifted immediately, giving the governments the necessary flexibility to take measures to tackle the crisis. Fiscal stabilizers, fiscal adjustments, general escape clause of the Stability and Growth Pact. And I remember very well, and I would like to thank Mario and all my colleagues, on that Eurogroup, the word for fiscal stabilizers and fiscal adjustments was for fiscal rules, and we added the words fiscal rules, targets, and requirements to capture also Greece, because we are in an enhanced surveillance mechanism. This means that Europe has the flexibility in order to capture all problems that many different European countries face. Regarding the financing of the program, the financing of the plan we have in order to recover, we have ensured fuels to implement our coherent policy. We manage domestic resources with prudence so that they are not exhausted in the current fight against the pandemic. We make full use of the increased fiscal space created from the given flexibility and liquidity that stem from the decision of the European Commission, the Eurogroup, and the European Central Bank. We are ready to use, to the best of our ability and at the right time, the existing European financial instruments. We demand drastic and innovative financial solutions at the European level. And finally, we are successfully borrowing from the markets. Thank you.
Thank you very much indeed, Mr. Staikouras. While we have Mario here, so let's just pursue a few points, and I will come back to you with some questions in a few minutes, Mr. Megalou. I wanted to pick up on something that Mr. Staikouras just said about fiscal rules. Obviously, fiscal rules have been put on hold for now, but presumably at some point after the worst is over, there will be pressure on countries, and particularly on the southern European countries, to consolidate and rein in their deficits. So how will they cope with this? Is this not, might we not see the possibility of more north-south divergence, perhaps resentment growing again? So how do you see that? You're in a pole position as head of the Eurogroup to talk to us a little bit about that. And I will follow up, Mr. Staikouras, on some of your specific questions about Greece. And also just to add in another question so that you can take this as well, Mario, before you go. How much resistance is there really? Because we've heard so much about countries such as Austria and Denmark, Netherlands, Sweden, the so-called frugal states who've previously called for very strong conditionality and rejected measures leading to debt mutualization or significant increases in the EU budget. So if in the end these countries accept the latter, debt mutualization and an increase, some increase in the budget, will they not insist then on the former, strong conditions? Will we see conditions attached to loans and grants?
Thank you, Johan. That's a very provocative question in terms of the way we think Europe, and it's quite important to face it already at this moment. Coordination is an integral part of European integration. By no means we will find a way to continue this process, this very virtuous process of European integration, if we don't coordinate, if we don't put together decisions that are taken at the national level with decisions that are taken at the European level. So we must look at our rules, and indeed we introduced all extent of flexibility available in our rules to face these pandemics. But we need to understand that after this temporary crisis, that is not explained by any sort of endogeneity coming from the economic or the financial systems. We must go back to it's not go back, because as I mentioned before, we need to coordinate, and coordinate is of the essence to face all of this, and that's precisely where Europeans showed the world their commitment already today. So this is something that is going to be part of our experience in the years to come, as it was before. But now we are dealing with it in a much more complete and set of institutions. And the common debt issuance is not to replace all debt. We are not doing that. We are doing in a very innovative way for Europe in a process that is meant to spread the costs of the crisis over time. And that was one of the key paragraphs in my report, in the report of the Eurogroup to the European Council back in April. And we are delivering on it. So I will not comment on the negotiation, but I am certain we will find common ground, and that will include grants and loans. Let me remember you that this is also about the single market. The single market is a mutualized reality today in all our economic system. It is not true that we did not mutualize our lives, our economic lives, already in the process of European integration. This is something that if we don't understand, we will not be able to take all the words with the proper meaning that they have. The countries you mentioned are all deeply integrated in the European economy. They all benefit enormously, and rightly so, from this large, very large, actually the largest market in the world. The Netherlands exports 60% of its GDP, and the vast majority of those exports are for Europe. So we are really very much interconnected and, in a good sense, dependent on the fate of each other. So we are now being able to raise funds, common funds, today to pay back later. There is a component of solidarity because countries are in different starting positions, but there are no permanent transfers involved in this sense, because we will have to pay this back over time. I think it's very important to make sure that this overtime part means a long period of time, so that we cannot be exposed to a second wave, not of the pandemics, but of something that can be as devastating as the pandemics, which is a second wave of crisis that may be of a different nature, and we must avoid it at all costs. But there is no such thing as money for free in an integrated world as the Eurozone is. There will be strings attached to these recovery funds, just like there are conditions to spend structural funds. But make no mistake, there will be no Troika-style conditionality. Those days are fortunately over. At the same time, this money cannot be spent on current expenditures or permanent fiscal measures. Those days are over too, and I think this is what will define the coming months and years in a much more integrated Europe, from which all countries will benefit. Thank you.
Thank you very much indeed, Minister. And I know you have to leave us now, so I'd just like to thank you again for joining us this morning and giving your views, your insider views. Thank you very much for being so frank in answering this question as well.
Yeah. Thank you, JOAN. Thank you all of you for inviting me, and thank you to all my colleagues in this panel. I mean, we have been meeting often in video. I think we'll soon resume meetings in other format. It will have been great to be in Greece this time, but it was not possible. Thank you very much.
Thank you very much, and goodbye. So we'll carry on this discussion. We've still got about 15 minutes left before we have a short break and go on to our next panel. So maybe, gentlemen, you might wish to comment on some of those questions that I raised about fiscal rules, about the conditionality, and so on. And I have some more questions from the audience and several questions of my own as well. But first of all, did any of you want to come back on any of those questions, or indeed to respond to what Mr. Centeno said?
Yeah, maybe if I may, I would come a little bit on the question of fiscal rules. Because indeed, currently we have activated general escape clause, but also in a general escape clause, there is a point that member states need to keep in mind medium-term fiscal sustainability. So like it were or not, but of course this question of fiscal sustainability will not disappear from our agenda and from policy maker discussions. So it's clear that once we will move from a crisis to the recovery, at some moment we will be deactivating a general escape clause and normal fiscal rules will start to apply, and member states will have to move for prudent fiscal positions. Of course, we will have to accept that it will happen from different starting points, so from higher budget deficit and debt levels than it is now, and we will have to take into account also the needs of economic recovery. So we'll need to balance fiscal positions with the need for investment to finance recovery. And then specifically on high debt countries, that's why when you look at our proposal for recovery instrument, there is a strong emphasis on grants. So 500 billion out of 750 billion euros are grants. So it means member states will not have to directly repay, and this money will flow to the member states' economies without increasing the debt burden. And indeed, it's high debt countries which will be the biggest recipients, but also, for example, Central Eastern European countries, where the overall level of economic development and incomes are lower, will be net recipients of this support. So that's why there's also a strong grant component in our recovery instrument.
Thank you very much indeed. Okay. A few questions that I'm going to put out to you. Mr. Staikouras, of course, come in. Yes.
Yeah, if I may, thank you very much. As I mentioned before, coming back to what Mario mentioned, we know very well that this COVID-19 crisis is exogenous and symmetric. And our economies, our European economies, are tightly interlinked through supply chains, financial connections, and trade relations. This is why we have to ensure level playing field and to prevent, I said before, financial fragmentation and economic divergence at the European level. I will pick up some words coming up from Mario: integration, coordination, flexibility, solidarity, common ground through compromises in order to find bold, sufficient, ambitious solutions. And we have to move towards that direction. Regarding the high countries that Valdis mentioned before, I would like to inform you that before the COVID-19 crisis, Greek public debt had been following a downward trajectory and consecutive historical in bold yields. Despite the pandemic crisis, the Greek sovereign has successfully drawn resources from the international markets, issuing bonds and T-bills at pre-crisis yields. These parameters were recently highlighted by Valdis and Commissioner Gentiloni, and of course, this was confirmed by the ESM documents, taking into account mainly the profile of the Greek debt, its annual financing needs, and the official holders of debt. Of course, public debt will increase in all member states of the euro area zone this year. However, according to the European Commission's estimates, not our estimates, the European Commission estimates, Greece will have not the highest, the fourth highest debt increase as a percentage of GDP in 2020, but in 2021, it will be the country with the highest decrease of debt in the euro area, enhancing even more debt sustainability. Thank you.
Thank you very much. We have 10 minutes left, so I'm going to tell you some of the questions that have come up from the audience, and then I'm going to put a specific question to Mr. Megalou, who can come in. This is just to give you time to think about how you might want to respond to the questions. So the various questions, first of all, for Mr. Dombrovskis, I guess this one is most appropriate. So Mr. Centeno emphasized that we're not talking about permanent transfers and that it will be paid back over a time frame, but nevertheless, we are talking about quite a significant change in terms of intra-regional transfers. Does that increase the likelihood, do you think, of the Eurozone moving towards fiscal integration, and would you welcome that? That's one question. Several questions for Mr. Staikouras have come up. What is the total cost of COVID crisis measures for Greece, and how much will that affect the budget and debt? Primary surplus targets, I know you've touched on this already, but how much flexibility do you think there will be now? What's the state of play regarding the renegotiation of the primary surplus targets? And what sort of time frame do you envisage for getting back on track? What is the situation with the cash buffer for Greece? Will it be drawn down in 2020? And what is the state of play with the IMF? Will there be further early debt repayments? You might not be able to answer all of those, but those are some of the questions that have come up. So the questions for Mr. Megalou that have arisen. Well, broadly, what do you see as the main challenges for the Greek banking sector, in particular in the coming period? How quickly do you see consumer demand recovering in Greece, and more generally, what's likely to happen with consumer lending this year and next year? I think you've already talked a little bit about NPL, so that's all. And a final question from the panel, from the audience: how will you make sure that all EU funds will end up going to the right companies and will generate growth and jobs? So let's start with Mr. Megalou with some insight about the banking sector in Greece and more broadly, and what we can expect.
Thank you very much, Joan. What is, in my view, extremely important at this current juncture in terms of the biggest challenge is to continue financing the economy and make sure that all viable companies are being helped getting through the crisis, the pandemic crisis. It is the most important job that the banks have to fulfill at this stage, making sure that viable companies are being assisted in their effort to survive. And then, of course, what is very important, and I think this is what the EU Recovery Fund is putting forward, is filling the investment gap. Greece has had an investment gap for some years. With the EU Recovery Fund, we will be in a position to fill that gap and create sustainable growth, which in my view could be quite high from 2021 going forward for the next 4 years, making sure that way, through growth of the GDP, that we are also addressing the issue of debt to GDP as well. On demand generally for loans, we have had significant demand for corporate loans, not so much on the consumer side, but what is important right now is to finance the economy, as I said. So corporate loans, SME loans, loans to the agricultural sector are very important in my view, and we are very well placed as Piraeus Bank to fulfill that role.
Okay, thank you very much indeed. I know you've got to leave sharp, Mr. Dombrovskis, so maybe I'll take you next.
Well, yes, thank you for those questions. So to come back to the question of no new permanent transfers, well, indeed, what we are proposing is a temporary instrument. So our recovery plan is focusing on the years until 2024 to ensure also that this money is spent in a counter-cyclical way, concentrating especially now in the first years. But at the same time, of course, it given that it has strong grants component, it has certain redistributional effects as a budget, public budget typically should have. So there will be countries which are going to be so to say net recipients of those funds, and there are going to be countries which are going to be net contributors. Of course, sooner or later, this money will have to be paid back. So we are envisaging a time frame between 2028 and 2058, and it can be done through the contributions from member states or through raising new own resources for EU budget, and that's the path European Commission is suggesting. So in any case, it's significant change in the approach how we finance EU budgets, that we do a common borrowing and spend it through EU budgetary programs. So one can say that yes, those are steps towards bigger fiscal integration. But here I would emphasize that we are not talking here about Eurozone fiscal integration, because this crisis is hitting the whole European Union, and the recovery instrument is there for the whole European Union. There was a question how EU funds are going to, or all this EU funding which is going to be available, how it's going to be spent effectively, generating growth and jobs. Well, that's why we want to have this link with the challenges identified in member states, socio-economic challenges identified in a process of European semester. And that's why we want to have this link with the green and digital transitions. So we want to strengthen the resilience of our economies. And also the aim of this package is not to go back to the status quo before the crisis, but to facilitate, to accelerate.
Okay, we've lost the sound. But I think Mr. Dombrovskis made all his points quite eloquently there. So for the last 2 minutes, the floor is yours, Mr. Staikouras, to answer some of those questions, and then we have to finish sharply at 12:45 to have a short break before our next panel.
Okay. Thank you, JOAN. 4 questions, 4 answers. The total cost of the measures is estimated at 24 billion euros. or 13% of GDP. Primary surpluses, of course, we have to discuss it with our colleagues at the European level later on in the year when we will have new data regarding 2020 and 2021. This was discussed and picked up previously by my colleagues. Of course, we will find common grounds as always. On the third issue regarding the cash buffer and the financing of the program, I have already answered before how we have ensured fuels in order to implement our coherent economic policy. Mainly, we use the cash resources of the general government and its entities, of course, the budget execution, and we have applied for the SURE program and the AIB fund. We are not going to make use of this famous 15.7 billion euros cash buffer to the ESM. And finally, on the second early repayment to the IMF, indeed, a second early repayment was one of the options considered by the Ministry of Finance and PDMA before the COVID-19 crisis as part of our funding strategy. However, there was not, I repeat it, there was not any relative commitment to the IMF or to the European institutions. Evidently, under the new circumstances formed by the pandemic, our priority is to make the best possible use of the resources and funds available in order to minimize the social and economic consequences of the coronavirus. We will re-examine the whole strategy in the second half of the year. Thank you.
Thank you very much indeed. Thank you very much to all of our speakers from our first panel. That's the end of the first panel. I think we covered a lot of ground, so we're very grateful, gentlemen, for that. Thank you very much indeed.